The weighted average method of inventory costing takes all the unit costs under which a company purchased inventory at, weights them, and takes an average of the unit costs. This is called the weighted average cost per unit. It is calculated by taking the total cost of goods available for sale divided by the total units available for sale. This weighted average is then used to calculate cost of goods sold by multiplying the units sold by the weighted average. It is also used to calculate ending inventory in the same manner. Using the same example as I have for all the inventory costing methods, I show in this table how I calculate the weighted average cost per unit on the rightmost column. On April 10th, 120 units of inventory were purchased at $5 per unit. The weighted average cost per unit is simply $5. When the first sale occurred on May 4th, the units sold would be costed out at $5 each. Therefore, I have cost of goods sold of $100. After the May 4th sale, I have 100 units left at $5 each, so the cost of my inventory is $500. When the second purchase was made on July 10th, this upped the inventory from 100 units to 180 units. The total cost of goods available for sale also went up from $500 to $920. I need to calculate a new weighted average cost per unit here. By taking the total cost of goods available for sale, which is $920, divided by 180 total units available for sale, the weighted average cost is $5.11, rounded. This makes sense since the $5.11 is in between $5 and the $5.25, and an average is supposed to be in between its reference points. In calculating the second sale that occurred on August 17th, the 30 units sold on that date will sell at the going weighted average cost per unit, which is $5.11. 30 units sold times $5.11 weighted average cost per unit equals cost of goods sold of $153.30. Looking to the right column again leaves 150 units remaining in ending inventory at a cost of $766.70. A few things to note about the weighted average method of inventory costing under a perpetual inventory system. A new weighted average cost per unit has to be calculated every time a company purchases new units of inventory at a different price point. In my example, there are units purchased at $5 and units sold at $5. The remaining units are also carried at $5 apiece. But when new units are purchased at $5.25, this changes the weighted average cost per unit to $5.11. So purchases will change a company's weighted average cost per unit, but sales will not. Therefore, you will have to calculate a new weighted average cost per unit whenever there is a purchase, but not when there is a sale. When a sale occurs, you will cost out the sale at whatever the going weighted average cost per unit is. In my example, the May 4th sale was costed at $5 per unit because that was the weighted average cost on May 4th. But on August 17th, that sale was costed at $5.11 per unit because that was the going weighted average cost at that time. Due to the fact that you have to constantly update and recalculate the weighted average cost per unit every time a company purchases new units, the weighted average cost per unit is referred to as the moving average. This method involves intricate calculations, so I recommend that you read and review this example so you become very familiar with how this method works.